Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'll be guiding you through the latest news and trends that could impact your portfolio. Today, we're taking a closer look at the recent changes in foreign investment regulations in India. The Securities and Exchange Board of India, or SEBI, has announced an increase in the disclosure limit for foreign portfolio investors, or FPIs, from 25,000 crores to 50,000 crores. This move is seen as a step towards easing the regulatory burden on foreign investors and making it easier for them to invest in Indian markets. To break it down, this change means that FPIs with investments up to 50,000 crores will not be required to disclose their holdings, giving them more flexibility and anonymity in their investment decisions. This could potentially lead to an increase in foreign investment inflows into India, as smaller investors who were previously deterred by the disclosure requirements may now feel more comfortable investing in the country. According to Sunil Subramaniam, a market expert, this move is a signal that SEBI is willing to engage and make things better for foreign investors. He believes that it will have a significant effect on smaller FPIs coming into the market and investing, leading to a diversification of flows and less dependence on big-ticket sovereign wealth funds. However, it's worth noting that this change may not have an immediate impact on investment inflows, as other factors such as economic conditions, interest rates, and global market trends will also play a role. Nevertheless, this move is seen as a positive step towards improving the business environment for foreign investors in India. As we continue to monitor the developments in this space, it's essential to keep in mind that regulatory changes can have far-reaching consequences, and it's crucial to stay informed and adapt to these changes to make the most of your investments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're joining us again as we dive into the latest developments in the world of finance and trade. Today, we're going to tackle a couple of stories that have been making waves in the market. First off, let's talk about President Trump's recent comments on auto tariffs. It seems like the administration is hinting at delays or possibly even exemptions for certain countries. This news has sent stocks rising as investors breathe a sigh of relief that the tariffs might not be as severe as initially thought. But, as we all know, the world of trade is complex and ever-changing. So, let's take a closer look. According to reports, President Trump said that not all of the new tariffs would be announced on April 2nd, and that some countries may get breaks. However, he didn't provide any details on which countries might be exempt or what the criteria would be for these exemptions. This lack of clarity has left many investors and traders scratching their heads, trying to make sense of it all. Now, I know some of our listeners might be thinking, but Louis, isn't this just a classic case of Trump being Trump? And you're right. The president is known for his unpredictable style. However, as investors, we need to separate the noise from the signal and focus on the facts. The fact is that trade tensions are still simmering, and any changes to tariffs or trade policies can have significant impacts on the market. Moving on to our second story, we have a piece from the Japan Times about the president's decision to impose 25% secondary tariffs on countries that buy oil or gas from Venezuela. This move has sent oil prices climbing, and it's another example of how trade policy can have far-reaching consequences. Now, I want to be fair and balanced here. The administration's goal is to pressure Venezuela into reforming its government and economy. But, as we've seen time and time again, these types of tariffs can have unintended consequences. They can hurt American consumers, businesses, and even the very industries they're meant to protect. As investors, it's essential to stay informed about these developments and adjust our strategies accordingly. We need to consider the potential risks and opportunities that arise from these trade tensions and make informed decisions about our investments. And that's a wrap for this segment of the Riskwiser Zone. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. Today, we've been exploring the complex world of global politics and economics. As we wrap up this episode, I wanted to dive into a story that's been making waves in diplomatic circles. It appears that there's a growing rift between the United States and Europe, with some high-ranking officials in the U.S. administration expressing frustration with what they see as European freeloading on defense spending. This sentiment was recently highlighted in a leaked conversation involving several top advisors to President Trump, including J.D. Vance, Pete Hegseth, Michael Waltz, and Stephen Miller. Now, I want to emphasize that it's essential to approach this topic with nuance and balance. The conversation in question centered around a potential military strike to reopen shipping lanes, with some participants arguing that the U.S. should take action, while others expressed concerns about the potential consequences and the need for European allies to contribute more to their own defense. It's worth noting that these views are not universally held within the U.S. administration, and there are still many who value the importance of NATO and the transatlantic alliance. However, the fact that such sentiments are being expressed at high levels of government is undoubtedly concerning for European leaders and diplomats. European Foreign Policy Chief Kaja Kallas has accused J.D. Vance of trying to pick a fight with European allies, while other diplomats have described him as dangerous and obsessed with driving a wedge between Europe and the U.S. These are strong words, and they underscore the depth of feeling on this issue. As we consider the implications of these developments, it's essential to remember that international relations are complex and multifaceted. While there may be legitimate concerns about defense spending and burden sharing, it's equally important to recognize the value of cooperation and diplomacy in addressing common challenges. So, what does this mean for investors and risk managers? In a world where geopolitical tensions are on the rise, it's more crucial than ever to stay informed and adapt to changing circumstances. As we've discussed throughout this episode, there are many factors at play, from economic trends to political developments, that can impact your investments and business decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.